investors anything more than the market return? Check. Managers with a history of good performance, like Michelle, make lots of money. Check. That's a pretty impressive list of explanations, isn't it? And nobody has to be irrational, and nobody has to make mistakes. Some of you might be asking, if it's so hard to pick winners and losers, then why don't I just buy a few shares of a whole bunch of companies? That way I might win a little here and lose a little there, but I'm just about guaranteed to get what everybody else is getting, even the experts, at least on average. In fact, that's the whole idea behind index funds and some exchange-traded funds. A financial intermediary, such as the Vanguard Group or Fidelity Investments, pools small investments from tens of thousands of investors, buys a large portfolio of many stocks, and distributes any earnings to investors in proportion to the amount they contributed to the pool. We'll talk more about these in Lesson 13. For now, though, take the existence of index funds as evidence that lots of people agree that it's just too hard to pick winners and losers. Some of you have another question. Okay, you say, suppose I accept the idea that people like us can't pick winners and losers, and that stocks are fairly priced, or at least close enough for us to act as if they were. Why should I bother to watch these lectures? I have a lot of answers for that. First, even if stocks are fairly priced, there are still lots of things you need to do to make sure that you tailor your investments to fit you. We've touched on some of those already. In Lesson 2, we learned about the two fundamental securities. Stocks are an ownership claim, while bonds are loans. Both of those might be fairly priced, but they are very different, and you want to be sure you get the one that's right for you. In Lesson 4, we learned about the historical returns and volatility of stocks. Stocks clearly offer the potential for hefty returns, but that comes at the cost of quite a bit of risk, too. You want to be sure you take the amount of risk that's right for you. In Lesson 5, we learned that diversifying is one of the closest things to a free lunch you're going to find. That's important even in a perfectly efficient market. Before trying to beat the market, think about the risk of your job. Is it secure? Then you can probably take more risk. If you live and work in Texas, the #1 state for crude oil production, do you really want to buy lots of stock in oil companies? If oil production stalls, then your job is at risk at the same time your portfolio suffers. Do you own a construction company? Construction is notoriously cyclical. Maybe it's best to buy more stocks that aren't so cyclical, like utilities. Let's conclude this lesson with an assignment. Watch a business channel and listen to analysts and commentators, or read a few articles about whether you should buy or sell a particular stock. The goal here isn't to decide whether to buy or to sell. The goal is to see how you feel while you listen to the pros and cons of a particular stock. I'll bet that when you listen to one analyst tell you the reasons to buy a stock, you'll tend to believe him. And when you listen to the other analyst tell you reasons to sell the very same stock, you'll tend to believe him instead. That's a perfectly natural reaction. I feel the same way myself. But if we're that easily influenced by talking heads, then I, for one, don't want to trust too much of my money to a strategy based on beating the guys who trade stocks for a living. We can do just fine without playing that game.